Good afternoon, everyone. On behalf of New York MBA's President Jeff Pinard and our entire board, I thank you for joining today's webinar on compliance challenges in the mortgage industry. I'm Elizabeth Shaney, and I and Bill Kennedy are co-chairs of New York MBA's Education Committee. So before we get started, we have a few housekeeping items. Please use the chat function to notify us of any technical issues you may have. During today's webinar, all lines are muted except for our presenters. Throughout the session, you'll have the opportunity to ask questions. Please use the chat and/or Q&A functions, and we'll do our best to address those questions as they come up and also at the end of the session. We'll be sharing the presentation slides and relevant resources with you after the webinar. Stay connected with the New York MBA. We're on LinkedIn. Our website is newyorkmba.org, and our YouTube channel where we post recordings of our webinars. We urge all mortgage professionals to join Mortgage Action Alliance. It's easy, free, and a way to stay informed on legislative issues that can impact the way you do business. So at this time, I have the pleasure to introduce two Mallorys with the Bonadio Group. Mallory Conway is an Executive Vice President in Bonadio's Internal Audit Division. As a director, Mallory is responsible for providing internal audit and compliance services to her financial institutions clients. Mallory has been providing financial institution internal audit services since 2008. She performs operational and financial audits as well as compliance and loan review services. She is a member of the Institute of Internal Auditors and a certified internal auditor and a certified regulatory compliance manager. Mallory Litsky is a manager in Bonadio's Internal Audit Division. As a manager, Mallory is responsible for providing a range of internal audit and compliance services to her financial institutions clients and specializes in deposit and lending compliance regulations. She is a certified regulatory compliance manager and a certified internal auditor. So at this time, I have the pleasure to turn this over to Mallory and Mallory.
Great. Well, thank you so much. I know we don't have a lot of time today, but I appreciate everyone taking a few minutes during their lunch hour to join us to talk about things that excite us anyway in the mortgage industry. So I'll just get right to it. So this first slide that we're going to speak to kind of just talks a little bit about some of the industry challenges and some of the trends that we're seeing. And, you know, a lot of this may not necessarily be new to all of you, but all of these pieces, kind of these 5 areas that I'm going to touch on, really tie into direct issues that are related to the compliance challenges that we're seeing at a lot of our financial institutions, you know, during our own reviews and coming out of regulatory exams. So as we all know, the housing market right now is really tough. You know, with the COVID-19 pandemic, we saw a lot of things that we didn't expect, right? Home values are up. There's a shortage in the market. So it's making it really difficult for those looking to purchase a new home to kind of even get their feet wet in the market because things are disappearing so quickly or they're above their price point. So what's happened is there's been some new creation of products, right? So we're looking and talking about renovation loans and things like that. So Mallory Litsky is going to talk a little bit more about those products later, but when we introduce a new product, as we all know, compliance changes, that there's compliance changes with those that we all need to be familiar with, and sometimes things might slip there as we get our feet wet with those new products. Technology changes is another one that we see kind of influencing some compliance concerns. You know, there's a major use of AI technology out there. I think that's through all industries, but when talking specifically about mortgages and things like that, applications are coming in online that are through using some of these AI technologies, which maybe it's even entering information to get things started as a setup in your loan system. Also just updates to those softwares and making sure that when there is an update, is it actually compliant with what you need? Are you entering things into their correct fields anymore? Things like that, which if you're not, it can create some compliance concerns. Interest rates is another one. This is probably tying right in nicely with ARM products kind of together. Rising rates right now, you know, a couple of years ago, you know, we really were at probably some of the lowest rates we've seen in a really long time. I don't think rates have been where they're at now since probably the late 90s, early 2000s. So, you know, we're really seeing that rate spike there, which again, kind of ties back to the housing market. It's difficult to get a loan when the rates are so high. It's making purchases a lot harder, you know, and making sure that we're all kind of focused on those things. And as it ties into ARM products with these rising rates, now the industry is kind of trending more towards an ARM product, whereas before everyone was rushing to get these fixed rate mortgages, right? I'm sure you all know you were crazy busy for a couple of years there, doing a lot of refinancing in 2020, maybe trickling a little into 21. But now we're seeing more of these ARM products come along, which we know is a more complex product, right? It's not new to the industry, but it's kind of new right now. Some of your staff probably haven't even worked with ARMs before. So, you know, given that and the complexity of them, we're seeing a lot of issues, and I'm going to dig into a lot of details and some specific examples that we're seeing out there in the industry to kind of help you maybe stay in front of having those issues on your side. And then lastly, staffing constraints. I think everyone is feeling this right now. It can go one of two ways, right? Maybe you have not enough people, right? So now your resources are limited and we're all rushing to get things done. Maybe we're overloaded, things slip between the cracks, right? We miss some of those small details. And when we're talking about rate entry into your loan system, I'm sure all of you know what kind of havoc that can create if there's an error there. Or we're talking about having new folks, right? Turnover is up. So you're hiring new people. And when that happens, now they need proper training. They're not as seasoned. So all of that kind of combined together is creating some difficulty within the industry itself. I skipped ahead on a slide. Sorry about that. So just to kind of run through the top 5 areas that we're going to be covering today. I know there's a lot of other compliance concerns out there, but these 5 areas are kind of where we're seeing the trends, if you will. So as I mentioned, adjustable rate loan errors, probably every single client where we've done a mortgage documentation review, we've seen some type of adjustable rate loan error with that. And I'm going to give you some specific examples. And it really relates a lot to the construction loan as well. You know, that has its own can of worms with the interest only phases and things like that. But if you throw an adjustable rate on top of that construction loan, then you have a lot more room for error. Same thing with the renovation loans. Those are a newer product. You know, a lot of the secondary markets kind of getting into that. And you know, making sure that if you are offering those renovation loans, that all of your disclosures are accurate and you're keeping up to date with those. HMDA data inaccuracies is another one. Mallory Litsky is our resident HMDA expert here at the Bonadio Group. So she's going to speak to you a little bit about what she's seeing there. Private mortgage insurance. Again, that one, you know, it's been on the increase. We're seeing more private mortgage insurance in general, just because the down payments aren't as high as they were there for a while. It's harder for borrowers to get into the market and having, you know, maybe a 20% down payment. So we're seeing an uptick in that, which again, you know, the more that it's occurring, the greater room there is for error there. And we've seen a lot of term inaccuracies, which Mallory is going to talk about as well. And then lastly, just some miscellaneous closing disclosure and loan estimate errors that we're seeing out there. A lot of common disconnects between the two. We'll just briefly touch on those, you know, and try to kind of help you get in front of that as well. So adjustable rate loans, you know, I think the biggest thing that we're finding is index errors. And when I say that, you know, there's a lot of things that are contributing to that. The first one is the LIBOR change. You know, that index going away doesn't seem like that big of a deal, but if you have a lot of loan notes that had the LIBOR rate in it originally, now you need to come up with another rate, right? That you're going to use. And the idea is that your note indicates it's going to be something similar and being consistent across the board. We've seen instances where that is not the case. Maybe you're selecting US constant maturity of 1 year, but then maybe on another one, you're selecting Wall Street Journal Prime. You want to be really careful doing things like that. Maybe it's a product association and it makes sense for you, but you know, the idea is that whatever you select to replace, the LIBOR would be replacing across the board for those notes. There's a lot of incorrect index usage and rounding errors. And what I mean by incorrect index usage is maybe the wrong index itself is being used. That's a pretty simple explanation. You know, maybe your note says you're using the Wall Street Journal Prime, but then your loan system is actually using the US Treasury constant maturity of 1 year. that's a problem, right? Because now you're not pulling the right index, and maybe you'll get lucky and they would be close enough and it works out. But a lot of times, that doesn't happen. So you want to make sure that you're using the correct index. And also your servicing department and your underwriting department need to be using the same sources, right? If you're going to be looking at the US constant maturity of 1 year using the Fed Lewis site, then you need to all be using the same one. We have seen issues where sometimes there's inconsistency or maybe a timing issue. And those, if you're using conflicting sources, that's not going to agree. So you want to make sure everyone knows where they need to be looking for that. Also, dates. Dates are really important. As we all know, when you're going to calculate your APR and the information that's on your disclosures that are going out to your customer, you need to be consistent on the date that you're using when you're calculating that first rate change. If we're talking about an adjustable rate loan, are you using the application date? If you're using the application date, then that should be used across the board. If you're using loan estimate date, then that's what should be used. You can choose from a variety of different dates, but you need to be consistent throughout all of your loans, because otherwise then that could end up creating issues of, giving an inequitable rate or something like that. You don't want to run into those types of issues. Rounding errors associated with the index is another big one. So generally, most notes, it's to the nearest 0.125, right? And I don't know about all of you, but I don't trust my math skills sometimes when it comes to rounding. So I always use a calculator because sometimes, maybe you're going in the wrong direction with it. And 0.125 doesn't sound like a lot, but it can make a big difference when we're talking about an APR violation, right? So if your system's not calculating it for you, do your staff know how to do this, or if there's a resource out there for them to make that rounding so that it is accurate. There's also been some issues with floor and ceiling errors. And what I mean by floor and ceiling is that you have the lowest the rate can go based on the note, and then the highest the rate can go. We've seen a lot of verbiage changes with this, which was really interesting. Typically a couple of years ago when we would see an adjustable rate mortgage put on, the note would indicate that at your first rate change date, your rate's not going to go up or down by more than 2%, and it won't go up or down by more than 2% on any subsequent change, right? But now we're seeing a lot that don't have a cap on that first rate change other than the ceiling that's in the note. There's not that 2% stopgap there on the first rate change. It continues moving forward with the 2%, but not initially, which is interesting. So basically, your rate could go to the maximum amount on the first change date, which is a little bit different than what we've been seeing. And I'm going to have an example of that here in a second. And it really feels right into an inaccurate projected payment table. So when we're talking about our loan estimate and our closing disclosure, we have our projected payment tables. And also, it includes your loan calculations table that's towards the end of your loan estimate and your closing disclosure. So if there's an issue there with the way you've entered in your rates, it's going to create a whole slew of issues for you. But before I get into the actual disclosures themselves, I want to talk really briefly about the servicing side of things. So, from a compliance standpoint, and what we've been seeing is when you're, and even on the underwriting side, or, whoever's providing the disclosures to your customer, right? That early ARM disclosure needs to be provided. It needs to be provided at application. And we've seen a couple of instances at some clients where they forgot to provide the notice. It's getting triggered within their loan system, but no one had a lot of experience with ARMs in some of these cases, and they weren't actually providing it at application. That is part of the regulation there, that does need to be provided. And then the first change disclosure. So this is your initial rate change notice. So in your servicing department, when you're approaching, so we have an 8-1 ARM, I'm going to use that as an example, probably quite a bit throughout this presentation. So when you get to year 8, that rate could change, right? So now we need to send out a notice, the initial one, 210 to 240 days prior to that first change happening. So, when you get to that year 8, you need to start thinking about that and making sure your servicing department is aware these notices need to go out. Again, we haven't had a lot of adjustable rate loans, so making sure your systems are prepared for these and that your staff are well trained to know that it needs to be provided. And then there's also an ongoing disclosure of rate change, and that happens 60 to 120 days prior to the first change. So we're going to send that initial rate change and then an ongoing one for it as well in that first change. And then any subsequent change gets this ongoing notice. It's basically letting them know what their payment's going to change to so that they can be prepared for that, especially, if their payment goes up. That's important for them to know so that they can be planning ahead, right? So this is probably maybe the most exciting part that everybody is looking to know. I know it interests me a lot. These projected payments tables, I could have given you 100 examples of issues that we've seen. I'm not sure we've had a clean one in a while. So the projected payments table is basically giving your borrower the worst case scenario, right? I think we all know that. So what I've done here is giving you a quick snip of the language from the note itself, telling you what the limits are on the interest rate change, and then shown you a sample of the projected payments tables that we've seen for this. So here, this is exactly what I was talking about with that strange verbiage change. It says the interest rate I'm required to pay at the first change date will not be greater than 10.75 or less than 2.75. So right off the bat, at the first rate change, this is a 7-1. So as soon as we hit that 8th year, this could go up to the maximum rate. So I tried to make it easy to follow. We've got a green check mark. Green means go, green means good, right? And then we've got this red X over here. So we'll look quickly at how it's done accurately. I always like to explain the accurate one first so we don't learn it wrong the first time. So here, this is disclosed correctly. You see year 8 has a minimum payment and a maximum payment, and it's the same 8, 9, and 10 through 30 because this is giving the worst case scenario. And now you don't have that cap here anymore on that 2% change on the first rate change date. So it's going to go up to the maximum or potentially the lowest. And that's how these minimum and maximum payments are displayed here, which is correct. This one over here with the red X, that one is there's a slew of things wrong with this one. It was difficult for me to find one that only had an issue with that maximum and minimum amount. But if you look, you can see, all right, year 8, it changes. It goes to a minimum and a maximum amount, which is greater than years 1 through 7. But what happens in year 9? Now we're gone down to 1430 with a maximum of 2821. And then in 10 through 30, we're even different. So what we think was probably happening here in this case is there was some type of adjustment happening for that 2% cap. But in reality, what you're trying to do is when you're disclosing it, it needs to be disclosed as that worst case scenario out of the gate. So, this one was wrong in a number of ways, like I said. So if you try to do the math on it, it might not work out exactly to it being what I've described, other than you should be seeing the same minimum and maximum throughout that payment stream there. So that's just one example of, how that payment table error can look, but there's a whole slew of different things that can happen here outside of this interest rate limit piece that I'm talking about. Making sure that your rate change happens on the right date. I'm going to show an example next of a construction loan. So if we move on here to this construction loan projected payments table, it's very similar to, obviously what we're looking at when we're talking about a non-construction loan, but this one happens to be an 8-1 and it has a 1-year interest only period. Year 1, this is correct. They've got the interest only period disclosed here. And then years 2 through 8, we have our P&I payment, right? And then after year 8, that payment's going to change. So this disclosure is correct in this way, but we've seen some where maybe it's not factoring in that 1-year interest only correctly. That's part of your first 8 years. We've seen a lot of cases where the disclosure doesn't reflect that. We have a year 1, and then we have another set of years 1 through 8, which is not accurate. So you want to make sure that your system is set up to have those terms in there correctly, but also that your staff understand how this actually works. And they're not just memorizing what a construction projected payments table should look like and we move on, right? Because they need to understand, if they understand the basics of how this needs to look, they would be able to see an error. They might not be able to know exactly what it is, but they would be able to tell at a quick look, this looks funny to me. And then maybe raise a red flag before that disclosure actually goes out to your customer. Because ideally, none of us want an incorrect disclosure to go out, right? And it's even worse if you end up with a reimbursable violation, right? So I don't have a slide here that specifically speaks to the loan calculation section, but that's the section of your loan estimate and your closing disclosure that starts talking, or your closing disclosure that talks about your total payments, what the finance charge is, your total amount financed, what your APR for the life of the loan is, and then your total interest payments for your TIPS calculation. Now, if you think back to when I was talking about those interest rate changes, if we don't have the right interest rate, so basically how that works, if you need a little bit of feedback, I spend my days calculating these, Mallory, and I live and breathe this, but when we're testing these, we're looking to make sure that that table is correct. And if you have the wrong index, meaning what you're trying to show the borrower on that loan calculation section is what is a realistic picture of what my loan might look like and cost me over the, say, 30 years, if it were in today's market, right? So it's going to show the initial rate like we have, maybe if it's an 8-1 ARM. So the first 8 years, that payment stays the same. Then when it changes, what it's doing in that calculation is taking, okay, the index and the margin from your note, but it grabs the index as of, again, like we talked about, your loan estimate date, if that's what you're using, your application date, your rate lock date, whatever you're using, it's grabbing the index as of that date, adding the margin and rounding it according to your note. And then it projects the rest of that 30 years using that. So it calculates the APR, your total interest payments, all those things that I just talked about. But what happens if you go in the wrong direction? Now, if you over disclose, not ideal, right? Maybe you went up a little bit high on the rate that you disclosed by, maybe you rounded it wrong by 0.125. It's not ideal. It's going to be over disclosed. So at least there isn't any reimbursement due to your borrower at that point, but it doesn't look good, right? But if you go in the other direction, and we have a pretty tight tolerance on anything outside of a construction loan. So if we're talking a standard adjustable rate mortgage with no construction phase, you're held to a tolerance on that APR of 0.125. So when we recalculate that, that's pretty tight, right? 0.1% is not a lot. And so if you round the wrong direction and you're too low, now you're under disclosing. And so then that's where you can really run into some problems, and you might have to reimburse your borrower, and that's not what you want to do. And again, it doesn't look good, right? So it's really important that you understand how those boxes are being calculated, because again, even if you just have a little bit of understanding of what that should look like, you can see a red flag by just simply looking at the numbers. You can say, you know what, I can tell that that doesn't look right. I think we're using maybe the wrong index, or, maybe something is wrong here. So spending a little bit of time on these adjustable rate mortgages, because I don't think they're going to go away, at least not in the next few months or so. I mean, I'm not giving any rate advice, but, I think that they're here to stay at least for a little bit. So making sure that everybody understands how that works is really important. I know, Mallory Litsky, if you want to maybe share the example that you had recently with some of these errors in the payment tables.
Absolutely. Yes. It's a great transition, because that conversation of the loan totals on page 5 of the CD versus that projected payments on page 1 of the CD, that's a conversation that I have with my clients just about every single time I do an audit on mortgage loans. And the confusion is exactly between what information is displayed on those tables, where does it come from, and why are there some issues but not others? And the key thing to remember is that the projected payments table, as Mallory said, is a worst case scenario projection. The table on page 5, where you have your total payments, your amount financed, your finance charge, your APR, and your TIPS calculation, that's a realistic table. So they should be different. And that's what we look for. We want to make sure that they are accurate in their own right, but they're not necessarily feeding off of each other. So to understand the calculations for that page 5 table, we do have that conversation with our clients. What date are you using so that we can replicate our calculations using that same date? And that's one of the first questions we'll ask. Are you relying on the application date, the loan estimate date, the most recent rate lock date, the commitment letter date, the initial CD date? Those are some of the more common dates that we see. Once we've confirmed that date, we confirm the index, and we go out to the index. We make sure that we're looking at the correct date, the correct index, and we run the calculations. More often than not, when we see a variance on that table, it's because we have the wrong date. And that can happen a lot. Most commonly when you have a rate lock, or a rate lock that happens mid underwriting, and those dates are not adjusted in the core system to reflect that newest information. So the future disclosures are still generating based on older data. So we want to make sure that the systems are calculating those dates correctly. Certainly, if there's an option for a manual override or a manual input, that again, staff is trained properly to understand when that's needed and what date to make sure is in. So we do work off of all of that information together. Mallory and I have done several trainings this year on loans, primarily on adjustable rate loans, and we've run through some variations of calculations. It was actually impossible for us to find an example of a construction to perm ARM loan that did not have an issue within the last 12 months. So that speaks to, the industry and the environment in general. You are not alone if you are having questions or issues, or if you've had your own exam or audit comments. Everybody's, working through the same concerns and questions. So I want to put that out there as well. And definitely keep that chat box open. If you've had something that's come up recently, a question or a concern, this is your opportunity as well, because you're with your peers right now and you have us as a resource. So please feel free to put that in the chat box for us. One of the other key issues that we've noted, as Mallory touched on, was the construction to perm phases, where that initial interest only phase, and I'm going to refer to that as 12 months because it's the most standard, but obviously we know that that phase can change, where those 12 months are not calculated properly in the dates of the disclosures and in the dates of the notes. So we have seen where, let's just say, a 30-year mortgage with a 1-year construction phase is calculated in the note to only mature after 30 years. So even those dates are not matching up, and that can obviously affect payments as well. So we really want to keep those things in mind. The construction only phase also really impacts that table on the loan estimate with the first 5 years of projected payments, because that construction only phase does need to be included in those first 5 years, in that first 60 months. However many months of your construction phase, that's included in the 60 months. And we've seen a lot of examples over the years, and I'm going back more than 1 year on this as well, because this is a constant concern, where that construction only phase is not included, or it's not included properly. So we've seen those tables go out to 72 months because they're adding an extra year. They've actually been 48 months, just completely removing the construction phase. And we've seen them for odd numbers, 61 months, so we want to make sure that those tables are calculating properly and understanding what a construction interest only phase means to the loan. I want to throw out a couple other examples here as well, while we have arms on our minds, of actual real life situations that have happened, most of them within the last 6 months. So as Mallory alluded to before as well, when you want to make sure that your underwriting and your servicing departments are using the same information, we did have a conversation recently where the general index that was being used was the US Treasury 1-year constant maturity weekly average. And that was being used for most of the disclosures and for all of servicing. But when it came time to generate the CDs for these loans, loan underwriting would jump to the same 1-year constant maturity daily average. And again, those are not identical indexes, but they're similar. And they were different enough in about half of the files we were testing to show a variance. And the reasoning was that the daily rate at the time of closing would be more accurate than a weekly rate that could be 4 or 5 days, kind of outdated at the time of closing. So we very strongly encourage and recommend that everyone make sure that not only are you using the same resource, that you're using the same index. Luckily in this situation, there were no APR violations. There was nothing extreme because the rates were so similar. But we do want to be careful with those calculations. One of the other things we've seen a lot of as well, again, with the switch in the industry to a lot of adjustable rate loans, is the borrower's questions to transfer product type mid underwriting, where maybe they might start with a fixed rate, maybe they might start with a 10-1, and suddenly along the process they go, you know what, I changed my mind, I want a 7-1. So you really want to make sure that when you're updating that process wherever your loan is in the pipeline, that you're updating everything accurately to reflect the current requested accurate loan product. More often than not, what happens is something gets mixed because the system is smart enough to realize adjustable rate fields are not required for a fixed rate, so they're blocked, they're empty, move on. But it's not smart enough to realize that it has to input them later on if that product changes. So now you have the manual input. Again, you can run into some issues. Sometimes half the information will be uploaded correctly, half of it will attempt to pull from somewhere and it's not connecting properly. So we've had two instances recently, one where a loan was changed from a fixed rate to an ARM, and it had to be a manual input of the index, the date, and the index rate at that time. And so the employee put in the index and the date, but not the index rate. And the system was smart enough to understand the limits of that note, which was the 2% up or down variance for rate change. And it took the index at the time and said, we're going to bump it up 2%, and that's going to be how we disclose it. So, the system was able to function properly, but it was not as accurate as it could have been. So there was a slight variance in that loan as well from what we would expect to see, simply because that field was missed in the process. We had another situation where a loan went from a fixed to an adjustable, and for whatever reason, the system could not compute adding in adjustable factors. And the CD was generated with $0 amounts all throughout. So on page 1, it had the loan amount, it had the interest rate, but other than that, it was zeros. And on page 5, it had the loan amount, and then everything else was zeros. And that wasn't caught. And so luckily we were able to go back and figure out what happened and redisclose properly. But something like that, you want to keep an eye out for in your QC process. When you have a unique situation, make sure that there's extra eyes on that file so that it is finished and disclosed and put into your system properly. And that can affect your underwriting, and it can affect your servicing. I have a couple more observations, but I did see some questions come through the chat, so I just want to look at those real quick. We have one: if you have an online application which includes ARM loans, how and at what stage are you issuing the initial ARM disclosure? Great question. So when you have a loan that comes through initially as an ARM, that ARM disclosure should be provided within 3 business days with all the other disclosures. Hopefully that's typically what you're seeing, and that would be a best case scenario. But again, if you have something like what I was just talking about, where you go from a fixed rate to an ARM, you're going to want to disclose that initial ARM disclosure within 3 days of the change in your system. So once you're notified and approve that change to an ARM product, within 3 business days, you want to send out that disclosure. Hopefully that answers your question, but if something else more specific, please let us know. And the second question that came through, as long as you disclose properly, the draw period or interest only period does not have to be a part of the 8-year span from your example. If you have an ARM program disclosure, loan estimate, CD, and note are all lined up, then it's okay. Is there a regulation that states otherwise you can refer me to? We'll look into that one for you, but it also depends on your loan product. And I'll get into this in a little bit, actually, with construction loans, as to how your construction loan is built in your system. Is it a 1-phase? Is it a 2-phase? How does it flow from the interest only into the perm phase? So I'm going to hold on to that comment for specifics, and I'll get back to you in a little bit on that one. Please keep the questions coming. So one of the other comments I want to mention, as Mallory said, when you have that consistency in your in jumping up your loan interest payments from going that 2%, 2%, 2%, and suddenly it's 5%, worst case scenario. We had a client that I've been working with for years, and it's been consistent, 2%, 2%, 2%, 2% across the board. Suddenly they had one loan where something happened in the system and that 2% was taken out. And so the note was disclosed at 5%. All the loan estimate, closing disclosure, everything matched up perfectly because it was all built in together at 5%, but it wasn't consistent with all of their other loans. And we discussed it, and they said to me, is this acceptable? I said, technically it's disclosed, properly, but it doesn't match your system. So definitely keep an eye out for things like that. That consistency is so key. And I am going to circle back to that word again when we talk about HMDA in a little bit. Let's see if there's anything else I just want to touch on real quick with these examples. They're everywhere. The one last one I'll mention at this point, because it's a very unique situation, but if you do have something like this, definitely keep an eye out for it. We tested a construction to perm loan. It was an ARM. I can't remember if it was a 5-1 or 7-1, or, it's definitely an ARM. The construction phase was monthly interest-only payments. The permanent phase was biweekly payments, and there was PMI attached to the loan, which started at the construction phase into the permanent phase. When you have all of these factors together, that can really impact how your system calculates and how you can attempt to manually recalculate everything to make sure that it is disclosing properly. So make sure that you, again, do keep an eye out for those unique situations. Your auditors probably have that innate ability to pick out those problem child loans. So we want to make sure that should they be tested by somebody else as well, that everybody is aware of any potential issues or errors or corrections that may have been made, and be able to identify them for loans down the line. Okay, that was a lot of examples. There are more, so I may throw some more out at you, but I'm going to move on. If you could, Mallory, advance me to the next slide, please.
Before we move on to that, I'm just curious. I know we need to keep moving along, and maybe we'll save some of the questions if we have time at the end. And if not, we can reach back out with responses just so that you can suggest your content. But I am curious, now that you've kind of heard some of the examples that Mallory and I have given on this, I don't know if anybody, if you can just throw in the chat, like, are you seeing this at your own organizations? Maybe just hit yes, or, for sure, or if not, say no, just so we can kind of get a read from the 30 of you out there, like, what are you seeing?
Yeah. And one thing to keep in mind as well, regardless if it's an ARM, it's a construction, it doesn't matter what type of loan it is. The one thing across the board is prepaid fees, making sure that those are categorized and charged appropriately so that they filter out where they need to in your disclosures as well. Okay, so we just talked about construction loans. Renovation loans. This has become a real exciting field, I think, and it's kind of exploded in the last year to year and a half with all the trends that we've talked about, and certainly some other things you might be seeing in the industry right now. That this is another option that can be taken in so many different directions. For anybody who's currently offering these loans, for anybody that's considering these loans, or even if you are not aware that these exist, again, please feel free to put anything in the chat, any advice that you have, especially any problem spots that you've run into to help out your peers here. But a brief overview of what is a renovation loan and why is it not a construction loan, right? So a construction loan is vacant land, and I'm going to put something on top of it and live in that new dwelling. A renovation loan is specifically designed for an existing dwelling. So you're not building from scratch, you're not tearing down and rebuilding, you're enhancing what you have. And as you can see from this slide, there are a lot of different programs, and certainly a lot of different options to go with, places that are offering them, certainly the advice that you can get from these as well. So these programs that are more generally based, and I think the FHA 203 is the more common one that I've seen out there, but certainly Fannie Mae, Freddie Mac agencies have some of their options as well. That these loans are built to really encourage your borrowers and to revitalize their communities. And I know some of you might be putting on your CRA hats right now, so bear with me on this one. But when I say enhance and revitalize, the market being what it is, where the pricing of houses is just astronomical, you can get a really run down house for $500,000 just based on the location. So if you're not able or not in a position or want to get a new house like that, but your existing house could, use some facelifting, this could be the loan for you as well. That sounded very infomercial, I apologize. Where it builds in updating, doing some home improvements, with a lower interest rate, an easier monthly payment. It can be built into a refinance or a purchase mortgage. So you have one loan to pay, not a loan and a home equity line of credit. There are certain factors that need to be taken into consideration based on your program. So some of the programs have dollar limits that you have to go with. For instance, The renovation cost must be greater than $5,000 or must be greater than $35,000. So whatever the cost of the loan is together, that portion must go to the renovation. Are you remodeling your kitchen? Are you adding a deck? Are you doing landscaping? All of those things count towards renovations. Again, you're not tearing anything down. You are enhancing what is there. The benefits, as you can see from the slide, there are so many different benefits that can come with this. The key benefit is you're living in that house. It's yours. You're making it your dream home. And that's something that a lot of people might not know is an option for them. One of the other things, we've talked a little bit about PMI and down payments. For some of these programs, you only need a 3 or 3.5% down payment to be able to get financing for these loans. That's much more manageable in this market right now. For first-time home buyers or folks that are looking to get back on their feet, you can purchase a house that is not in peak condition with the renovation loan concept and be able to have that portion of your mortgage for renovation costs and the portion for the purchase of the loan. So you're still doing a manageable loan payment. Obviously, PMI might come into play based on the program and the institution that the borrower is working with, and that's up to your policies and procedures to determine that. There are some additional requirements for these loans, again, depending on the product. Some of them require a certified builder or general contractor to oversee everything, and you can't switch in the middle of the renovations. They require certified professionals for things like plumbing and electricians. You can't just go to your friend down the street and say, oh, well, they worked in the industry, they can do it. You have to have that level of professionalism involved in these loans as well. The interest rates are typically a little bit lower as well. So in this environment, that definitely helps. And the underwriting is a little more relaxed. So it doesn't rely completely on a credit score necessarily. It takes other factors into consideration. Again, some industries, Fannie Mae, Freddie Mac, they offer more available underwriting approval guidelines for these types of loans. So if you're not already offering these or considering them, I recommend that you take a look. I can tell you for a fact your peers are doing them if you are not. So you definitely want to make sure that you're staying relevant in your community as well, while making safe and sound loans, of course. Mal, if you could advance to the next slide, please. Okay, so just to circle back to the construction loans, make sure, the difference between the renovation loans, the construction loans. We've already talked about most of these, but I just want to, I can't believe I'm going to say this, hammer in these details to make sure that we really make sure that these concepts you take with you and you take back to your staff and hopefully be able to be aware of all of these high points, hot topics, if you will, to make sure that all of your loans are being disclosed and underwritten properly. Next slide, please. Okay, HMDA is a 4-letter word. I think we all know this, but HMDA also means good things. We all went through that expansion 5-6 years ago of 32 fields, 110 fields. Oh my gosh, how are we doing this? And unfortunately, there are still a lot of confusions, questions, issues, errors, and resubmissions that I've seen over the past few years. I want to go over a few of these key items, especially as they relate to all of these loan products that we've been talking about. Some of these, of course, are mostly for the large servicers. If you have that small servicer exemption, these might not apply to you. However, per the regulation, you do need to be able to collect this data. So we want to make sure, again, that if you have a system that's collecting it, it's collecting it properly, that you understand where these errors might come into play. So the rate spread, well, this is another calculation that's built on a date. So you want to make sure that you have the correct date and that you have the most accurate and up-to-date date. So if you have your rate lock, if you have your commitment letter, if something changes and it needs to be redone, make sure that you redo that calculation using the correct information so that the rate spread is accurate in your HMDA. The lien status with construction loans, renovation loans, home improvement loans, all of these different types of loans, we're getting a lot of junior liens that are not necessarily junior liens. So we've seen an increase in home equity loans that are actually first lien loans. And we want to make sure that even if that product type is typically a junior lien loan, that if it is a first lien, that it's reported as a first lien. So this is something where you can't rely on your computer system, because what worked in the past is not necessarily going to work now. And keep an eye out again for those unique situations that might fall into these categories. The purpose definition, purchase, home improvement, refinance, cash out refinance, and other. Depending on your procedures, and this is key as well, you want to make sure that your loans are coded properly. We have several clients that we've worked with that I've done HMDA reviews with that define a cash out refinance in their policy. So you might have a dollar amount, for instance, anything that's cash out of 2,000 or more is considered a cash out refinance, regardless of the loan amount or any other purpose that might be involved in that loan. So if that's part of your policy and procedures, you want to make sure that you are documenting that correctly on your law as well. Obviously, the majority of loans can fall into the other status, and that's perfectly acceptable as well. Excuse me. And also keep in mind that waterfall effect, where if you have a purchase with home improvement, that it goes under purchase. That's the triggering purpose for the HMDA. And finally, again, construction loans, interest-only payments, and ARM loans, introductory rate periods. These numbers, we've seen a lot of issues, and I couldn't tell you if it started at, that concept of a fixed rate mortgage that somehow transitions into an ARM during underwriting, and that's not captured in the HMDA law. So you want to make sure that when you do have an adjustable rate mortgage, or even if you're offering an introductory rate for a certain period, maybe they're paying down points, maybe you have a certain system going right now where you're offering first 5 years at a lower interest rate, you really want to make sure that you're documenting that properly on your law as well, and that you are including your interest-only payments for your construction loans as well. There are a couple other common factors with HMDA that are not as common as these, and those, of course, are mostly date related as well. A lot of that is application date. So for anybody who accepts applications electronically, your consumers are mostly going to do that at night and on the weekends. So what business day are you accepting that application? When does it actually come through the system? And when is it taken in by your institution? What do you consider a completed application to be able to have that date accurately on the HMDA law as well? And your action date. And this is key for withdrawn actions. You want to make sure that that action date is as of when the borrower requested to withdraw, not when you processed the withdrawal. For denied applications, it's the date it's denied, not the date the second review is completed. And for loan originations of refinances, consistently, it's either the date of the refinance or the date that the funds are provided, that 3-day rescission period. So whatever date you choose, make sure that's the date that you're consistently noting on your HMDA law. Okay, Mal, next slide, please. PMI, we have talked about PMI on and off today, and we've seen a lot of different options for PMI over the last couple of years. Most notably, anything over 90% loan to value ratio requires PMI. But there's different programs. Certainly you can go to different resources to get your PMI approved. And we've seen some amortization schedules and some documentation that shows a change in PMI. So for instance, you'll start with, let's just say $40 a month PMI for the first 10 years, and then it drops to $30 a month until your LTV gets to that reasonable level. So if that's part of your disclosure, if that's part of the option, you really need to make sure that that information is provided to your borrower, that your amortization schedule is correct. And of course, that flows into your payment calculations on your loan estimate and your CD. So we want to make sure that that is being calculated properly. We have seen several options where PMI is attached for the life of the loan, and it changes periodically, usually annually, based on the current principal balance outstanding. So it will drop year after year after year, but it will never go away. So you want to make sure that those calculations are being done appropriately, and that when it comes time to recalculate, either your system or your processors are recalculating that amount properly as well.
Sometimes before you go on, Mal, sometimes we also see it in some of the like the assisted programs, like a USDA loan or things like that, you know, where the amortization schedule is not correct. So kind of watching out for those two, not just strictly, you know, PMI that you're purchasing on a regular mortgage, but also within those other types of loans as well.
Absolutely. Absolutely. And it certainly is a great option. The other thing we've seen, I think a little more frequently now than a few years ago, was that lump sum PMI payment option. If that's what you offer for your borrowers as well, where you can take that expected full-term PMI amount and just pay it up front as a closing cost. So if that's an option that you have, again, make sure that is disclosed properly. Next slide, please. So I want to go over a couple of very common mistakes that we've seen on loan estimates and closing disclosures, these next few slides that we have. And first we have here the cash to close tables. So on the left-hand side of your screen, this particular loan file happens to be redisclosed 3 times, 2 revised LEs and the initial LE, and then the closing disclosure on the right. So as you can see with each copy of the loan estimate, you have some changes to that cash to close table, but nothing matches the closing disclosure, cash to close table. Something got mixed up along the lines there. And so you want to make sure when you have those changes that prompts a revised loan estimate, that information, again, is properly flowing through and it is being documented in the system so that the closing disclosure is accurate. If you have a change that does not prompt a loan estimate, but it's going to, you know, change how things are disclosed, you want to make sure you don't have any changes that would prompt that redisclosure for reimbursement purposes that might be missed along the lines here. For this particular example, I can say that everything else on these 2 documents was perfectly fine. These 2 tables just didn't match up. So something might have been checked at one point and then unchecked or vice versa, and it just didn't flow from one to the other. I'm going to rush through the next slide, please, because I want to make sure that I saw some more questions come through. Oh, this one's a big one, and this is a couple different situations here. So for the loan estimate, the first bullet here, the terms are not available for 10 business days. You want to make sure that your system properly categorizes what is a business day for your institution and what is not. And the most common mistake that we see in these calculations is federal holidays. And I have to say, it's mostly in the wintertime. So it's Thanksgiving and Christmas and New Year's. For whatever reason, those dates are not always being counted into these 10 days factor. So you want to make sure that if your system can be set up with those parameters, maybe you don't do business on Saturday. So you want to make sure that that date is not counted as well, that you're providing those same full 10 business days to your consumers. The other thing I want to touch on for this is that even if your loan estimate does not have the correct date for 10 business days, what's really important for the regulation is that you continue to offer those terms to your borrower for 10 days. So that date is not like, you know, a make or break situation. You don't need to redisclose if that date is incorrect, but you do need to offer those terms. If that borrower comes back on day 10 and says that they want to proceed with the loan, you still need to honor that. The other thing that we've seen consistently, it doesn't matter what type of loan product it is when a loan estimate is revised and redisclosed, that date is still there. Or it's changed, but it doesn't need to be there. So for this particular example, as you can see, the original loan estimate was in December of 22, and it was revised in January of 23, but that expiration date is still as of December 31st, 22. So for that revised loan estimate, it didn't need to be there. This loan already had the intent to proceed documented, so there was no need to have that disclosure. If you do not have that intent to proceed, you need to make sure that that date does extend another 10 days so that you're giving that borrower the additional time that they have to accept or question those loan terms for you and make sure that they're getting the product that they want. So this is such a common issue that we see. We want to make sure, again, staff understand when these dates are needed, what do they really mean, and when to update them as necessary. Okay, next slide, please. Q&A. I did see some more questions come through, so let's open up the chat real quick. Oh, going back to the ARM questions. ARM online application. That's a tongue twister. So the compliance consultant said that the early arm disclosure must be provided at the time of application, not within the 3 days of the application. I think we might need a little more information on that particular example. Again, if that loan started as a fixed rate, there's no way you would provide that disclosure at the time of application. So feel free to circle back to us with some additional details on that loan if you can. Our contact information is coming up, and you will be getting a copy of this information as well. So please reach out to us. And certainly if anybody else has any questions that you have not put into the chat, feel free to reach out to us as well. We do want to provide as much accurate information as we can to you. We want to see accurate loans out there as well.
Yeah, so if anybody wants to reach out to us, our contact info is here in the slide deck. Don't hesitate to reach out. We're always happy to answer questions. We're always all learning something new. I feel like this, the mortgage compliance environment is ever changing, and we're all able to learn from each other. So don't hesitate to reach out. And, we really appreciate everybody joining us today. I know we're just about up on the 1 o'clock mark. We stayed on target today. So thanks for joining us, and we hope to talk to everybody here again soon.
Well, great job, guys. Thank you very, very much. To both Mallory and Mallory from Bonadio for that really deep dive into the information, the level of detail that they included on the slides as well. The Bonadio team has been a long-term member and sponsor of the New York Mortgage Bankers Association, so we certainly encourage all of you to reach out to their firm if you have any business-related needs as well. As you guys know, we also will now it takes a couple of days, but by next week, you will be able to access this whole session once again if you would like to, and we certainly encourage you to do so. We'll post it in our socials, and particularly on our YouTube channel. So when you go to YouTube next week, just type in under search our full name, New York Mortgage Bankers Association, and then you will see this and then other previous webinars that we've held. But certainly take the opportunity, watch it again, share it with any other members in your company, and if they have those questions. And then, as they showed you both, please reach out directly to either Mallory or Mallory. So on behalf of the New York Mortgage Bankers Association, great job, guys. Thank you very, very much for taking the time today, and we appreciate it and hope everybody has a good day.